So you mentioned a term. Let's talk about that a little bit. A weighted double diagonal. Did I get that right?
Yep.
You want to do one of those so we can explain it a little bit? What do you think?
Go ahead. I'll give you.
You tell me what to do, and I'll put it in here, and we can talk.
We'll use the SPY and use the October 26 expiration start.
Okay, 5 days away, right?
Right now, so I'm looking at the October. So it's 343. We figures at the money, right?
Yep, you got it.
I'm looking at that, and I'm adding the straddle together in my mind, which is adding the call and the put together.
Okay,
that's about $6. Okay.
Yeah, this one in the middle. Are we selling that one?
No, we're not going to sell, but I'm explaining how I get to where I go.
Okay, go ahead.
Now, I'm going to go. I'm not going to go quite. No, I don't want to sell that. I'm not going to go quite $6. That tells me that this stock should move in the next 5 days. It should move about $6.40 either way, plus or minus.
Okay.
What I'm going to do is I'm not going to go all the way 6 out. I'm going to go about 4 strikes on each side. So I'm going to sell a 339 put.
Okay.
And I'm going to sell a 347 call.
Okay.
And now I'm going to go out to, let's say, November 6th.
Okay. First of all, let me just highlight this real quick. So when you say you're selling those, so that's a strangle we're selling, right?
Yep.
Okay. We're getting about $2.90. That's about midpoint on this particular strangle. Right. And I'm just clarifying. That's all.
No, you're good.
4 strikes down, 4 strikes up is how we created that. Okay. So the red, just for the viewers, that red those are the sell legs that we have built so far. Now we're moving out to.
I could be this good of an artist with my computer.
Pretty good, huh?
Yeah.
November 6th, you said?
Yeah, we'll start.
Okay, so we're going after the election. Just the note, right? I'm not saying one way or the other. Just saying that's post-election.
So now we're gonna go. What we're gonna do now is we're gonna buy 2 calls and we're gonna buy 2 puts. So I'm gonna look at. I'm gonna go. Okay, so I'm gonna buy 2 337 puts.
Okay, so 337 puts 2.
And I'm gonna buy 2 349 calls.
Okay. Is there any magic to why you picked those 2 strikes?
Well, I can't go. I don't want to go too far away from the money.
Okay.
But the stock has enough capability to move that kind of price range.
Right.
So I'm willing to give up the $2 spread in the middle, because when you look at this spread, so this is $17.80. Is that what that says?
Yeah, 17.85. I'll make it an even number. So 17.85.
That's good. That's all right. So first thing I usually do is I look at it and I go, okay, so it's 17.80. Right. So I've got how many rolls? So I got 1, 2, 3. Going back to I've got about 6 rolls approximately.
Yeah. So you got if you go back to the 26th, right?
We got about 6 rolls. We got about 6 rolls forward.
Yep, you do. 1, 2, 3, 4-ish. So yeah. So let me just highlight that so people can see. So we're selling this October 26th expiration.
Right. Now we're going to roll to the 28th.
Yep. You're going to go 1 roll.
Yep.
2 rolls, 3 rolls, 4 rolls, right?
And then 5. We're going to roll to the 6th too.
And we're going to roll to the 6th, which would be the 5th one right there. So
right.
That's 5 rolls.
Right. It's 5 rolls plus there's 1, which I'll explain after I finish talking about this trade. So
okay,
I'm paying $17.80 for this trade. Okay. So what is my true mathematical risk if I lost the maximum I could lose on this trade and I didn't do anything in the 6 rolls that I was planning on making? Okay. So what is the actual maximum? Do you know how to figure that out? Okay. And of course you'll show them some fancy machine. Me, I say you can take those risks, yes, and you can, but anyway. So I just say I'm paying a $17.80 debit. Okay, I've got a $2 spread risk on either side.
Yep.
It cannot be on both. It can only be on one or the other. I can only lose the spread on one side or the other. Right?
Yep.
Okay. So to me, I looked at it, I go, okay, so in real math, which is impossible to get there, but in real math numbers, I got $19.80 worth of risk. Now, I know I can never get there because I have to be an idiot to not touch it for 6 rolls.
Wait, did you say 1980 or 1780?
What?
What is it? Is it 1980 or risk?
It'd be 1780 debit plus the $2.
Plus the $2. Okay, I just want to make that clear. So let me just show. We're going fast. 1785 plus your $2 strike differential, right?
Right.
But it's only on one side. It can only be on one side. It can either be on the put side or the call side. It can't be in both places. Is what we're saying.
Which is why, just a quick point here, which is why people, when they trade iron condors, they get in trouble because some of them panic on one side and then they cover the one side that's the biggest loser. And then they go cover the other side. When that becomes the big loser, and they lose twice as much.
Right.
You can't, going right now, going in, I know that the most I could potentially lose here is 1980. Now I know that that's virtually impossible. I mean, I will say to you that the real risk in this trade is probably somewhere between $3 and $4. That would be the real risk. If things went bad, we would probably lose $300 to $400 per time we did it. If nothing good happened, but obviously that's pretty hard to happen. But that's, again, there's not anywhere near the risk we're showing, but you have to show it because that is the actual mathematical number.
Sure. So what do we want to happen here? I mean, I know what, I think I know what we want to happen, but you're going to do some rolling here, which means you're going to keep collecting some money toward this ultimate premium out November 6th, right?
Well, I know for sure, okay, that I'm going to roll every other day. Okay.
Okay.
Now, what I would like to, and I know right now, based on what we looked at now, okay, I can get about $2.80 or so per premium per roll, approximately, give or take, depending on what's going on with volatility.
Yep.
But if volatility keeps rising into the election, I'll probably get more. But let's say I can get 250 for the roll.
Okay.
So I'm gonna get. So I got my. So we take my initial cost of 1785. Now I get 250 on the 28th. Okay. So now my initial cost is what? It's now 1535.
Yep.
I get 250 on the 30th. And now my initial cost is 1285.
Yep.
And I keep reducing that number. In the meantime, okay, should we get a big spike one way or the other, okay, we have one extra long put and we have one extra long call. So what we're going to do is, if we get a big spike, we're going to roll one option away and capture that premium at the same time. And if by some miracle we get a trending market that keeps going, we can keep rolling that call, okay, and taking money off the table while still trying to sell part of the guts and collect a little premium. Now, what happens when it goes in the money like that? First of all, your opposite side, if the market gets cracked and we go down to, let's say, 342, 322, well, your 349 call is worthless and you're not gonna be able to sell any premium against it.
Right.
So all you're doing is really selling the put, you're reselling the same put, and hopefully you can get, 30, 40 cents, credit, it's hard to get when they get deep in the money. There's not nearly as much credit, but you're making your money now on the actual long put. Once you've overcome the $2 spread, which we talked about, and all the premium, it's all profit. And these trades can be extremely profitable if you get a big trending market once you're in. Now, the ideal situation, obviously, is to get a couple of rolls out of the way, get that cost way down, and then you get a giant move. And then
that's